So the next one is changes to capital gains tax. So this is, so what I mean by this is in relation to investments and how investments are taxed. Currently, as I just mentioned, if you own a property or shares, for example, and held those type of assets for more than 12 months, half the capital gain is tax-free. Yeah, pretty straightforward. What Labor is proposing is to actually reduce the exemption from 50% down to 25%. This isn't really anything new. They did actually have this policy in the 2016 election. They've just regurgitated it again for this election. So it applies to assets which are owned by individual taxpayers or trusts. So it'll be family trusts, unit trusts. Interesting, a super fund is a trust, but that's unaffected by this change. The proposed start date is unknown, so that's something again we're sort of playing, but having gone through a lot of the Labor policy documents, they're proposing to put a lot of these changes in the first 12 months that they were in office. So it could be a 1 July 19 start date or 1 July 20 start date, so it's going to be happening fairly rapidly. Why the change? The reason being is that Labor believes will just increase housing affordability. I mean, the two major tax concessions that investors do use is the 50% discount and negative gearing, and they're attacking both of those because they believe that, say me as an investor, has the advantage over someone who's looking to buy a home, because I can use these tax concessions to actually make it more affordable for me to make the bank repayments, for example. If I'm negative geared, I've got someone paying my rent, I'm getting a tax deduction on the negative gearing, which is the excess of rental expenses over rental income, and I can get that back as a refund, put it back into the loan, reduce it a lot quicker than a homeowner. So I've got a lot more ammunition when I'm looking for a property to buy that property, because I've got these tax incentives. So what the government's trying to do is to really equalise everything and have a level playing field, and that's the reason for the change. But there are exemptions for it. So any investments that you own currently before the commencement date, whether it's 1 July 19 or 1 July 2020, they'll be grandfathered. What that means is that they'll be unaffected by the changes. So if you were to sell those assets, they'll still get the 50% discount. So that's great. It's only any new investments in shares or property, they're the ones that will be caught by that. Investments by self-managed funds, as I mentioned a little bit earlier, then the effective capital gains tax rate, if you're in accumulation, that is, you're not in a pension at all, is 10%. Provided that you own that asset for more than 12 months and sell it for a gain, the capital gains tax rate is 10%. So that's unaffected. And the other one there is small business assets of business owners. So if you had a business, say it's in a trust or individual name, you sold your business and you've got goodwill attached to it, or the factory that you work out of, that will still get the 50% general discount. You won't be part of these new laws either. So they're the three exemptions that do exist, or that will exist. So an example about the capital gain, just look at the tax impact. So on the left is the current, on the right is the effect of the 25% discount. So sale price $1 million, purchase price 500 grand. Net effect on a very basic capital gains tax calculation is that there's a difference there of close to $60,000. So it is significant. And as we drill into the next couple of slides, when we sort of add that to the negative gearing changes, we'll see the full impact of the Labor policy really targeting housing and making housing more affordable. So what that means also, this is a very powerful slide, just take a moment to ponder that one. When we speak to clients, we're talking about capital gains. We always say the maximum tax rate that you're going to pay for any sale of an asset with the capital gain is 23.5%. Now look at the proposed changes, 35.25%. It's an absolutely massive jump. It's 12%. So what does that really mean? Do you, before the commencement date, if Labor does to get in, do you go out and buy that property that you want? Notwithstanding that it's a volatile property market, downward spiral, there's a lot of negative press and everything else. But do you bite the bullet and say, well, geez, that 50% discount's very attractive. That might be worth paying a bit more for a property today because I'll get the tax benefit later on. And that's a consideration as an investor that you would have to make. The other one is in future, after the commencement date, if you were to buy investments, what structure do you use? Do you stay with the trust structure? Do you stay with an individual structure? Do you go into a corporate structure? We've got a lot of clients, and I'm not sure whether this is too technical or not, that have a family trust, and they use a bucket company to distribute profit into to cap the tax rate at 30%. because that entitlement that's gone into that company is unpaid. Do the trust actually physically pay the money into that company and start investing through that company? Because the tax rate now is 30% in a company, but the effective tax rate on a capital gain is 35%. And they're the sort of considerations that you have to think about with structuring. So it's going to mean a lot more thinking if Labor does get through in terms of what is the most appropriate structure and how we can actually get the best result from a tax point of view as well. So there's something to consider. So that one is a very scary slide when you look at it in isolation. It's a very powerful slide. And that shows the full impact of what Labor's trying to do. They're really trying to tax any decent capital gains that are made at a very high rate to really to get more money into the budget. So, changing landscape, as I've mentioned, review structure ownership before acquiring an asset. You purchase investments pre or post the change, and will the negative gearing changes affect your investment decision. What I mean by that, we'll move on to